Hi visitor, this is Unknown with Known. I hope you won't regret this video. In this video, we're going to talk about our market crash in 2021 and how it bounced back after that. So without wasting any time, let's start. Shortly in 2021 market crash. The market crash of 2021 refers to a sharp decline in global stock markets that occurred in late January and early February of that year. The crash was triggered by a combination of factors, including rising bond yields, concerns over inflation, and uncertainty surrounding the COVID-19 pandemic. During the crash, stock indices around the world fell sharply, with many losing over 10% of their value in a matter of days. The S&P 500, a stock market index that tracks the performance of the 500 largest companies in the United States, fell by over 12% in 1 week, and the Nasdaq, which is known for technology companies, fell by over 15%. The market crash also affected other markets, including the bond market, where bond prices fell as yields rose, and the cryptocurrency market, which saw a sharp decline in prices. The crash led to widespread panic and concerns about the global economy, and many investors and analysts feared that it could lead to a recession. However, the market has since recovered, with many indices reaching new highs in the following months. It is important to remember that market crashes are normal and happen frequently in the market, and it's important to understand the market trends, risks, and diversify the investment portfolio to minimize the losses. Is COVID-19 responsible for the 2021 market crash? COVID-19 played a role in the market crash of 2021, but it was not the sole cause. The pandemic has had a significant impact on the global economy, leading to widespread job losses and economic uncertainty. However, the market crash of 2021 was triggered by a combination of factors, including rising bond yields, concerns over inflation, and uncertainty surrounding the COVID-19 pandemic. The pandemic has led to widespread lockdowns and closures of businesses, which has resulted in a decline in economic activity. This has led to a decrease in corporate earnings, which in turn has led to a decline in stock prices. Additionally, the pandemic has led to increased uncertainty, which can lead to increased volatility in financial markets. The market crash of 2021 also coincided with the end of the U.S. fiscal stimulus package, which provided financial support to individuals and businesses during the pandemic. The expiration of this package led to concerns about the potential for a decline in economic activity, which also contributed to the market crash. In summary, while the COVID-19 pandemic played a role in the market crash of 2021, it was not the sole cause. The market crash was a result of a combination of factors, including rising bond yields, concerns over inflation, and uncertainty surrounding the COVID-19 pandemic, as well as the end of the U.S. fiscal stimulus package. How to market bounce back from 2021 market crash? There are several ways that the market can bounce back from a crash, such as the one that occurred in 2021. Some of the most common ways include: 1. Monetary policy. Central banks can use monetary policy to stimulate economic growth and boost market confidence. They can do this by cutting interest rates, which makes borrowing cheaper and encourages spending and investing. 2. Fiscal policy. Governments can also use fiscal policy to stimulate the economy and support market recovery. This can include measures such as increased government spending, tax cuts, and increased unemployment benefits. 3. Economic recovery. As the economy starts to recover, companies will see an increase in profits, leading to an increase in stock prices. This is usually the most important driver of a market rebound. 4. Time. The market tends to be volatile and tends to correct itself over time. Often, after a crash, market participants tend to buy when prices are low, leading to recovery. 5. Diversification. Diversifying investments across different asset classes, sectors, and geographies can help to minimize the impact of a market crash. It's important to remember that market recoveries can take time and the pace of recovery can vary. It's also important not to panic and make hasty decisions during a market downturn but to stay invested in the long term. However, it's always important to seek professional financial advice before making any investment decisions. Difference between 2008 and 2021 market crash. The market crash of 2008 and the market crash of 2021 are similar in that they were both triggered by a combination of factors and led to sharp declines in stock markets around the world. However, there are also some key differences between the two crashes. 1. Causes. The market crash of 2008 was primarily caused by the subprime mortgage crisis, in which a large number of homeowners defaulted on their mortgages due to the collapse of the housing market. The market crash of 2021, on the other hand, was caused by a combination of factors, including rising bond yields, concerns over inflation, and uncertainty surrounding the COVID-19 pandemic. 2. Scale. The market crash of 2008 was much more severe than the crash of 2021, with many indices losing over 50% of their value. In contrast, the market crash of 2021 saw many indices lose around 10% of their value. 3. Economic impact. The market crash of 2008 had a much more severe impact on the global economy and led to a recession. The market crash of 2021 also had an impact on the global economy, but it has not yet led to a recession. 4. Recovery. The market crash of 2008 took much longer to recover from. It took the S&P 500 index several years to reach its pre-crash levels, while the market crash of 2021 saw the S&P 500 index reach new highs within a few months. 5. Government response. The government response in 2008 was much more extensive than in 2021. In 2008, governments around the world intervened heavily in the markets through fiscal and monetary policy, including bank bailouts, quantitative easing, and fiscal stimulus packages. In 2021, the response was more focused on fiscal policy as the US fiscal stimulus package was ended, leading to concerns about the potential for a decline in economic activity. It's important to remember that market crashes are normal and happen frequently in the market, and the causes and impacts can differ from one crash to another. Is new investors seeing downfall during 2021 market crash? During the market crash of 2021, the value of many stocks and other investments fell sharply, which likely had a negative impact on many investors, including new investors. However, it's important to remember that market crashes are a normal part of the investment process and that the market has a tendency to recover over time. New investors may be particularly affected during a market crash because they may not have as much experience navigating market downturns and may be more likely to panic and make hasty decisions. It's important for new investors to understand that short-term market fluctuations are a normal part of investing and that a long-term investment strategy is more likely to be successful. It's also important for new investors to diversify their portfolio, which can help to minimize the impact of a market crash. Diversifying investments across different asset classes, sectors, and geographies can help to minimize the impact of a market crash. It's also important for new investors to have realistic expectations about their investments' returns and not be overly influenced by short-term market fluctuations. While market crashes can be scary, history has shown that over time, the market tends to recover and even grow. It's always important to seek professional financial advice before making any investment decisions. GDP downfall during 2021 market crash. It is likely that the market crash of 2021 had an impact on the GDP, gross domestic product, of countries, as stock market crashes can lead to a decrease in consumer and business confidence, which can lead to a decrease in spending and investing. Additionally, the lockdowns and business closures caused by the COVID-19 pandemic likely also contributed to the fall of GDP. However, it's important to note that the relationship between stock market crashes and GDP is complex, and the impact on GDP can vary depending on the specific circumstances of the crash and the state of the economy at the time. During the market crash of 2021, the GDP of many countries was affected, as the lockdowns and business closures caused by the COVID-19 pandemic led to a decrease in economic activity. However, the GDP of some countries has started to recover as economies started to reopen, and the market has recovered as well. It's also important to note that GDP is a measure of economic activity. It's not a measure of the well-being of the citizens, and it's not the only metric to evaluate the state of the economy. Other metrics like the unemployment rate, inflation, and consumer sentiment also play an important role. It's important to keep in mind that the economic impact of the market crash of 2021, as well as the COVID-19 pandemic, is still ongoing, and the final impact on GDP will be clearer in the future. Tips for new investors and example. Here are a few tips for new investors. 1. Start small. It's important not to invest more money than you can afford to lose. Start with small investments and gradually increase your investment as you become more comfortable with the process. 2. Diversify. Diversify your portfolio by investing in a variety of different assets, such as stocks, bonds, and real estate. This can help to minimize the impact of a market downturn. 3. Do your research. Before investing in any company or asset, do your research and understand the risks and potential rewards. Look at the company's financial statements, management team, and industry trends. 4. Have a long-term investment strategy. The stock market can be volatile in the short term, but over the long term, it tends to go up. Don't be swayed by short-term market fluctuations and stay invested for the long term. 5. Stay informed. Keep up with the latest market news and trends by reading financial publications and following investment experts on social media. 6. Seek professional advice. Consult with a financial advisor or professional before making any significant investment decisions. An example of a new investor following these tips could be someone who starts by investing a small amount of money in a low-cost index fund, which is a type of mutual fund that tracks a stock market index like the S&P 500. This fund provides diversification across many different companies and sectors, reducing the risk of investing in a single stock. This investor also does their own research on the fund, its fees, and performance, and also consults with a professional advisor. They also set a long-term investment horizon and periodically review the portfolio and make changes based on their research and market conditions. Thank you so much for your valuable time. I hope you all are gained some good knowledge from this video. See you in next topic. Till then, bye-bye.